Alright, so now we're going to do a stock market example. So stock prices are approximately log normally distributed, at least in the short term. And that means stock returns in percent are approximately normally distributed. So we can use that, the norm inverse function in Excel, to do simulated random stock returns given specific input parameters of the market we're talking about. So, but in general, dollars next period is going to be equal to 1 plus the return in percent as a decimal times dollars today. So the long run average of the Dow Jones Industrial Average is roughly 0.5% per month with a standard deviation of 5%. So then let's think about a $1,000 investment. What's going to happen month after month after month? Can we simulate a year of stock returns and calculate an average? The answer is, of course, yes. So we'll start with our $1,000, and then we're going to take our norm inverse rand mean of 0.05, standard deviation, 0.005, it's 0.5% per month, standard deviation of 0.05. So that's our percentage return. So we're going to take the old amount times 1 plus this random stock return. So again, we're going to get, well, here, this is what we're going to do eventually. Let me show you what the stock returns look like themselves. So 2%, -4%, -3%, 0.5%, 4%. So we've got these monthly returns that move around all over. So we're going to translate that into the value of a portfolio by multiplying by, so old amount times 1 plus the new amount. Okay, and then we need to do that 12 times. So what's the first one? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. We're going to make those a little bit smaller. Here, I'll just... Let's see, column with the 6 about. There we go. So now we have a sequence of stock prices. So I'll go a little bit narrower. 4. 5. Okay, so we've got our stock prices. So we start at 1,000 and start at 1,000 and then end up having all of these prices. Okay, so that's one simulated year. So let's just do this for a bunch of years. 2, 3, 4. And look what it does. It's Excel's way of... Okay, so now let's just take a look at a plot so you can see what we're actually doing here. So get a line plot. So notice as I hit delete, it refreshes the plot. So these are the simulated paths. So this does really sort of look like, you know, you can imagine if I took a Dow Jones Industrial Average chart and normalized it to a starting value and stuck it on top of each other. You may have seen charts like this with respect to jobs in recessions. So we'll often normalize to a jobs level X months before the start of a recession and then see how the recovery is looking relative to other recessions. So here's our simulated price paths. And so I'll get rid of the picture here, but the numbers will still be there. And now we can ask this question. So what is the average ending dollar value of the stock? So we'll go ahead and just fill down for a while. Oh, I forgot. Gotta grab 2. So we'll do 1,000-ish. And then we're going to take the average of everything. 1,061, 1,065. And so it's moving around all over the place, but roughly 1,060. Okay, and we're doing that by simulating 1,000 different price path histories. So not only can we just calculate average outcomes, we can also calculate average likelihood of a particular event occurring. So here's an example. Suppose I invest 200 and borrow 800 at 4% APR. What's my probability of getting wiped out? So if I borrow 800, that means I have to pay 832 at the end of the year. So we can ask, all right, what's the probability that I end up under 832? So we can do that by simply typing if this is less than 832, give me a 1, otherwise give me a 0. Double click the corner to send it to the bottom. And then if we take the average of that column, it's going to tell us the percentage of the time we got a 1. And because if we have a 1 for the ones that where it happens and the 0 for the ones that it don't, taking an average is going to add up the total of events that occurred having a price less than 832 and divide by the total number of years tested. So we get something like 9%. All right, and that means, and again, this is, we just did that by just counting up every time it ended up under 832. So what was the interpretation of the scenario? Well, if we bought stock on 20% down, 80% margin, we would have a 9% chance of getting completely wiped out. So our entire investment would be taken away because the bank would call in our loan. And it's even worse than that, because if it falls under a certain parameter at any time during the life of the investment, that could happen to you. So if we really wanted to do this accurately, we would need to check whether at any point in the entire lifespan of the portfolio, whether it was beneath the present value of the loan at that time, plus a cushion. So it can be very risky to buy stocks on the margin, and you can have a very serious risk of completely wiping out your investment, at least at 80-20 margin levels. So nowadays, it's 50-50 would be a much more reasonable number than 80-20, and maybe even less than that. So this was us simulating a stock price and then doing an if statement to check whether our result matched certain criteria, and then taking an average of the ones and zeros produced by that to determine a likelihood. Okay, so here's your chance. So we've got $500 in the Dow Jones Industrial Average, and you're going to invest $500 in that and $500 in a 1-year CD that's going to pay 1.25% annual. So what is your average balance after a year? So that's one thing you can do. And then second, you can ask, all right, what is the probability that you'll be able to retire if you need 1,040? So should you do all stock, or should you do a 50-50 portfolio? So which is the higher probability of 1040? So that's something for you to try. And then there's some practice problems up on Moodle for you to cut your teeth on a little bit. And then the homework and quiz will be posted, and we'll get a chance to work through that on Wednesday.